But let's get to my next guest. And, well, investors have shied away from the housing market over the past year, but it's 2023 time to dip back in. Anthony Landahl from Equilibria Finance is at the desk to tell us. Anthony, great to get your company today. Again, another one probably the last for the year. It's only days until the holiday period, but always a good time for your retrospectives on 2022. Fair to say, been a reasonably tough year for the housing market.
Yeah, I think if we were sitting here 12 months ago, we were reflecting on record growth. And I think at the end of this year, we're probably looking at a fairly resilient market, actually. The housing market's been declining, but the pace of decline has slowed. We've had sort of 7% off the peak in April nationally. So I think the markets remain pretty resilient in what's been a fairly dramatic year on a number of fronts with monetary policy. We've seen the sharpest incline in interest rates for a very long time. Obviously, we're up over 3.1% now on the 6 months from April. That's up 3%. So it's been a pretty interesting year on the housing market, but I think the markets remain pretty resilient for a number of factors, and we'll see what 2023 brings. But I think the rate of decline is probably slowing. We might see an end to that in the new year.
It is an actual interesting point, actually, for some of the doomsayers out there. The market is still behaving fairly efficiently. It's clearing basically, which is always a good sign. Even if it is falling, it's not becoming dysfunctional. But might just get a question in there too, because of course we talk to a lot of economists and strategists perhaps, and they say, well, I'm looking at the data right now, and we're worried about an interest rate cliff, or I'm not too worried about it. I always love chatting with you because of the boots on the ground element. What do you feel we could be seeing there when it comes to that proverbial cliff everyone seems to be talking about?
Yeah, look, I think fixed rates went up about 40% through the period in COVID, and around about 70% of fixed rates that are in the market that were put in place then come off over the next 12 months. Yeah. I think there's some factors that will mean we probably won't have that cliff that people like to talk about. A lot of mortgage holders have strong buffers. Savings were built up over that time. A lot of mortgage holders also are starting to factor in those rate rises. So they're talking to their broker, they're talking to their bank, they're starting to make repayments based on what they're going to look like. So while there's going to be some people out there who struggle, I think in overview we're going to see, an increase for a lot of those mortgage holders who've been on those lower rates. But I think overall people are over the shock of the brutality of that initial increase over that period with those 50 base point consecutive rises, and are sort of getting prepared for those rate rises. I know a lot of the clients we're talking to, their fixed rates are coming off 3, 4, 5 months. We're already starting to have conversations about what their repayments will look like. I think another factor helping is our labour market is so tight, and I think that's helping mortgage holders remain resilient through this time as well.
I'm sure he's not going to mind if I speak about some of these financial circumstances on air, but my father bought a house during sort of an owner-occupier place during the pandemic. At the time, had to sort of go through a second-tier lender just because of access to lending or whatever. Anyway, obviously was going to head for this fixed rate cliff, but has worked with a broker, managed to refinance now, and because he's been able to pay down his mortgage so extensively through the COVID period, been able to get better terms, tier 1 lender, all that kind of stuff. Have you seen a lot of that as well? Just, I guess more broadly speaking, that, okay, maybe some people would have taken out loans that were at lower rates, they might have been fixed, but you're seeing people getting sort of proactive, looking for favourable refinancing and doing whatever they can to kind of, I guess, protect themselves from that shock?
Yeah, a lot of people are active in the market right now. A lot of people are either repricing with their existing provider, or, for example, in the case of your father, if they had a low deposit or there was a reason they originally went to a second-tier lender for loan-to-value ratio reasons, the growth in the market, the equity that they might have created might now be putting them into opportunities to move to first-tier providers, if you like. So there's quite a lot of activity. A lot of that activity we're seeing is with repricing with existing providers, as well as refinancing. There's a lot of refinancing activity going on at the moment with people looking around. But the reality still is rates have gone up, and whoever you go to, you're going to be starting to get that flow on through with the fixed rates coming off. But a lot of activity with existing mortgage holders, with their existing providers and refinancing.
Interesting. All right. Well, let's look ahead, I suppose you could say. and to perhaps some of the key factors shaping the housing market in 2023. We've already spoken about a couple of them, but what do you think, I mean, on top of that is going to be obviously the key variables there, especially as it relates perhaps to the investor class, if you will?
Yeah, look, I think the key things that are going to shape the market next year, obviously, are monetary policy and the flow-on effect of that. I think the other key factors are going to be whether we hit a peak in both inflation, the rate of growth, as well as the decline in the housing market. And if we start to see those things stabilise, then I think we're going to start seeing more activity in the market. The drop will slow or stop. I think a couple of other factors that are going to influence the market next year is going to be access to credit. Obviously, with the rate rises, a lot of people have adjusted their ability to access credit and what they're able to get, as well as the bank's appetite. So there's a number of factors that are going to influence and shape the housing market, but I think monetary policy is going to be the main one. I think for investors to come to that, investors were very subdued through COVID. I read some recent ABS data suggesting that investor finance was down about 20% April to October in 2022, but I think there's some factors that are giving investors some tailwinds. They've sat on the sidelines. We've got investors now who've created equity through the natural market growth, and we've got one of the tightest rental markets we've had. Vacancy rates are below 1% in some areas. So for an investor, cash flow is quite strong, which is quite attractive, and the rate of decline they're coming into a declining market, even though the rate of decline is slowing. So for an investor, it's quite an attractive time to start thinking about getting back into the market. So I think for investors next year, we're going to see some growth on the back of a declining market, which we've seen. We've come off the peak, as well as very, very strong rental yields out there at the moment, some of the strongest we've seen for a very long time. And they seem set to remain, with supply and demand being an issue. The borders are opening up with migration. So I think it's quite a nice environment coming in for investors. Negative gearing's also coming back into play. So there's a number of factors that I believe is making it an attractive market next year for investors to cautiously step back in.
Interesting. Anthony, really great to get your discussions again. Always enjoy that kind of, again, boots on the ground perspective. I don't know if we'll speak again. I've been saying this to everyone on the desk today, but if we don't, thank you for your contributions this year. Have a great holiday season. Anthony Landahl from Equilibria Finance.
No worries at all. Catch up next year.
Beautiful.